Hey guys, we are now here at the last topic of Unit 3, foreign investment. For the first part of this topic, we would learn three main things. The first, we would learn all the foreign investment related concepts such as foreign liabilities, foreign assets, and equity. Next, we learn about the relationship between current account balance or current account outcomes and foreign liabilities. And the last element that we would learn in this part is the factors that affect foreign liabilities. What does it mean by foreign investment? It is actually the investment in domestic companies and assets by a foreign investor. However, investor could be individuals or companies. Foreign investment involve capital flow. It could be inflow or outflow. For example, if residents of Australia invest abroad, that is a capital outflow, which in return would increase the asset ownership from the foreign countries. On the other hand, when non-residents invest in Australia, that is a capital inflow, which in return would result in foreign liabilities. In summary, we could conclude that foreign investment is cross-border movement of finance through borrowing or lending, purchase or sale of assets. Money from outside Australia used by the non-resident or the foreign investor to buy assets in Australia or to provide loan to the domestic individuals or residents. All these forms of foreign investment would affect the stock of Australians' foreign assets and liabilities. Foreign investment can be done by our resident or non-resident. For residents, if we invest abroad, it would increase the foreign asset of Australia. For example, when a resident of Australia lend money to a foreign non-resident, it will be debited from the portfolio investment account of Australia. However, in return, when non-resident or the borrower return the interest to the lender in Australia, it will be credited to the MPY account. When a resident from Australia purchase or buy foreign share in other countries, the money we pay out to buy the share would be debited from the direct or portfolio investment account. In return, when we make profit or when we receive dividend from the share, we would be credited into our MPY account. On the other hand, if a non-resident invests in Australia, it would increase our foreign liabilities. For example, when a non-resident lend money to an Australian, it would be credited into the portfolio investment account of Australia. In return, when the Australian resident repay back the interest to the lender in overseas, it will be debited from the MPY account as a debt servicing cost. The same thing, when a non-resident investor invests in Australian company share, it will be credited into the direct investment account or portfolio investment account. In return, when they make profit or when they receive dividends from their share purchase, it will be debited from the MPY account as the equity servicing costs. In conclusion, the flow of borrowing would affect the level of stock of debt, and the flow of asset purchase would affect the stock of ownership. For example, the more we borrow from foreign investor or foreign banks, it will increase the level of foreign debt. If we purchase a lot of assets from overseas, in return it would increase our stock of ownership from overseas. Just a recap, as we mentioned earlier, foreign investment involves the movement of finance across border. Investment fund inflow or outflow will be credited or debited from the capital and financial account. In return, the earning or the return on investment would be recorded in the MPY account as a debit or credit. When Australians take out money to invest abroad, it is a capital outflow which will be debited from the capital and financial account, and it will increase in return the foreign asset, which will be credited into the MPY account. However, the foreign investment into Australia, the money brought in by the foreign investor, is a capital inflow which will be credited into the capital and financial account at the first place. However, in return, the return on investment that we paid to the foreign investor would increase foreign liabilities, which will be debited from the MPY account. What actually affect the level of foreign investment? In specific, what are the factors that determine foreign liabilities? The first factor is saving investment gap. When a country like Australia in the past, our national saving level was low due to the small population size. Therefore, we need more foreign investment fund or capital inflow for us to sustain the development of economy and to maintain standard of living of people in order to achieve sustainable economic growth. Next, expenditure production gap. When the AE aggregate expenditure is greater than what we could produce, which is aggregate supply, then we need to fill up the gap through importing. Import would lead to trade deficit. To finance the trade deficit, we need capital inflow, and that increase our foreign liabilities. Next, the level of debt servicing costs would also affect the level of foreign liabilities. The more debt servicing costs that we need to pay back to the previous borrowing, the higher debt that we would have in the future in order to finance for current debt. As countries sign more free trade agreements that make it easier and make it simple for people to invest abroad, and the expansion of Australians' investment abroad definitely would increase the level of foreign liabilities. Lastly, fluctuation of exchange rate would lead to different level of foreign investment. If a currency depreciated, it would be cheaper for the foreign investor to come in to invest in certain sectors, especially those capital-intensive sectors like mining. And that's the end of part 1 of chapter 7 in your unit 3.